Welcome to the Deep Dive.
Glad to be here.
Today, we're really trying to stop flying blind,
Mm-hmm.
We're doing a deep dive into the economics of uncertainty. Basically, how everyone makes decisions when you don't know the outcome.
Right. Or how we should make them, maybe?
Exactly.
Yeah.
Because think about it. Changing careers, investing, even just like deciding whether to ski down a tricky slope, it's all risky.
It is. And that's why economists try to build a framework, a systematic way to think about it.
Okay.
We look at two main things. Probabilities, how likely is something to happen,
Right. The odds.
and payoffs. What do you actually get or lose if it does happen?
Makes sense.
If you can get a handle on those, you can move from just guessing to making a more calculative choice. But before we even get to calculating, there's this fundamental thing we need to understand about people.
Which is?
Risk aversion. Why we seem to hate uncertainty so much.
Okay, risk aversion.
Right.
Let's start with something simple, like a fair bet.
Good idea.
Say I offer you a coin toss. Heads, you win $1. Tails, you lose $1.
Okay. 50-50 chance.
Mathematically, the average outcome is 0, right? It's totally neutral.
Correct. The expected monetary value is 0.
So why do most people, myself included probably, say no thanks to that bet? Why does potentially losing that dollar feel worse than potentially gaining one feels good?
That feeling is risk aversion. It's this inherent dislike of uncertainty.
Just the uncertainty itself.
Pretty much.
Yeah.
A truly risk-averse person rejects a fair bet because it adds randomness, adds uncertainty, without offering any expected gain to compensate for it. And we dislike it so much that often we'll actually pay money, think insurance premiums, just to get rid of risk.
Okay, but why? If the dollars balance out, what's the problem? Is it just about the amount? Like maybe a millionaire wouldn't care about $1.
Well, interestingly, even many wealthy people would reject that bet. It's not really about the dollars themselves.
Then what is it about?
It's about utility.
Like usefulness.
Sort of. Think of it as your level of well-being or satisfaction that you get from your wealth. And the key insight here, a really huge one in economics, is diminishing marginal utility.
Ah, I think I remember this. It's the idea that, like, the more money you have, the less happiness you get from each extra dollar.
Exactly. That first $20,000 might be life-changing. The next $20,000. Still good, but maybe not as dramatically life-changing. The utility curve flattens out.
Okay.
And that diminishing return is what secretly drives your risk aversion. Let's go back to the coin flip.
Right. Win $1, lose $1.
If you lose the dollar, that loss comes from your current wealth level. Let's say that dollar provides a certain amount of utility, a certain amount of well-being.
Okay.
But if you win the dollar, you gain it when you're already slightly wealthier. And because of diminishing marginal utility, that extra dollar provides slightly less additional utility than the dollar you stood to lose.
Wait, okay. Let me process that. The pain of losing the dollar
In utility terms, yes.
is bigger than the pleasure of winning the dollar.
Precisely. Even though the dollar amount is the same, the change in your well-being isn't symmetrical. The potential downside looms larger in utility terms.
Wow. Okay, so it's not irrational. It's baked into how we value things.
Exactly. It's a fundamental consequence of that flattening utility curve. You're wired to value avoiding the loss more than achieving the equivalent gain, especially for amounts that matter to you. So now we know we're generally risk-averse, but we can't let that stop us from doing anything, right?
Right. Life involves risk. You have to take some chances.
Exactly. We have to navigate the risk-reward trade-off. We need to be willing to take on some risk, but only if the potential reward is high enough to compensate us for dealing with that uncertainty.
Like investing in the stock market. You expect a positive return over the long run to make up for the volatility.
Perfect example. Or starting a business. Huge risk, but the potential payoff could be massive.
And how much reward someone needs depends on them personally.
Absolutely. Your willingness to accept a particular risk-reward combination reflects your personal level of risk aversion.
So someone who's highly risk-averse might stick with safer bonds, or maybe never start that business.
That's often the case, and it correlates with other stuff too. People who are very risk-averse are often more likely to, say, wear seatbelts consistently, less likely to smoke, things like that. It's a general orientation towards uncertainty.
Okay, so let's make it concrete. Imagine a choice. Option A is getting, say, $5,000 for sure.
Okay, certain outcome.
Option B is a gamble. A 50-50 shot at winning $30,000, but also a 50-50 shot at losing $10,000.
Big potential upside, but also significant potential downside.
How does an economist, systematically decide which is better? Do you just go with your gut?
Haha, well, the gut is often where those biases live. No, we use a more rigorous approach called expected utility.
Expected utility. Okay, sounds like the fair bet calculation, but with utility instead of dollars.
Exactly right. You don't just average the potential dollar outcomes. You figure out the utility level associated with each outcome, the utility of having your wealth plus $30, and the utility of having your wealth minus $10.
And then you average those utility levels, weighted by the probability.
Precisely. You calculate the weighted average of the utility level. So 50% utility of wealth plus $30 plus 50% utility of wealth $10.
And compare that to the utility of just taking the sure $5,000.
Correct. The decision rule is simple. Choose the option that gives you the highest expected utility. That's the rational choice if your goal is to maximize your overall well-being in the long run, given the risks.
Okay, that makes sense as a system. But
Yeah.
then what about gambling? Lotteries, casinos,
Mm-hmm.
people pour money into those, knowing the expected dollar return is negative. How does that fit? Are those people risk-loving?
That's a common question. While it's possible some people are genuinely risk-loving, they get a thrill from uncertainty itself. A more generally accepted explanation ties back to consumption.
Consumption.
Yeah, I think of gambling not as an investment, but as buying entertainment. You pay for the experience, the thrill, the hope, the social aspect, whatever it is.
Like buying a movie ticket. You know you won't get your money back, but you get the experience.
Exactly. People are willing to accept a small, negative, expected financial return in exchange for the fun or excitement. It's spending, not investing, based on expected utility calculations. All right, so we're risk-averse, and uncertainty feels costly. Thankfully, we've developed ways to manage it, to reduce our exposure. There are about 5 main strategies economists talk about.
Okay, practical tools. Let's hear them.
First up, risk spreading.
Spreading, like spreading butter on toast.
Sort of. It's about taking one really big, potentially catastrophic risk and breaking it down into tiny little pieces, then distributing those pieces across a huge number of people.
Like you mentioned before with corporations and stocks.
Exactly. Imagine trying to fund a giant new factory yourself. If it fails, you're ruined. But if a company sells millions of shares, millions of people each own a tiny fraction of that risk.
So the potential loss for any one person is really small.
Right. It makes huge, risky projects feasible because no single individual bears an unbearable amount of the risk.
Okay, spreading the risk wide. What's number 2?
Diversification. This one's a bit different.
How so?
Diversification is about combining lots of different small risks whose outcomes aren't closely related. You're not necessarily spreading one big risk, but holding many unrelated ones.
Like the farmer planting several different crops, or an investor holding stocks from different industries.
Perfect examples. The beauty of diversification, and this is rare in economics, is that it often reduces risk without reducing your expected return. It's almost like getting something for nothing.
Why almost? Is there a catch?
Well, the catch is that diversification works wonders for idiosyncratic risks specific to one company or one crop, but it can't eliminate systematic risk.
Systematic risk.
Yeah, risks that affect almost everyone or the entire economy. Think about a major recession or a sharp rise in interest rates. Diversifying across stocks won't save you if the whole market tanks.
Okay, so diversification helps with specific risks, but not the big picture ones. Got it. What's next?
Number 3, insurance. This one's probably the most familiar.
Buying protection. Car insurance, health insurance.
Right. You pay a premium to an insurance company, and they promise to compensate you if a specific bad thing happens, a car crash, a house fire, etc.
Seems straightforward.
Ideally, you'd want what's called actuarially fair insurance. That's where the premium you pay exactly equals the expected payout from the insurer.
Like, if there's a 1% chance of a $10,000 loss, the fair premium would be $100.
Exactly. And a risk-averse person should always take actuarially fair insurance if it's offered, because it eliminates risk at no net cost.
But that's not the real world, is it? Insurance companies have costs. They need to make a profit.
Correct. Real-world insurance is almost never actuarially fair. You pay more in premiums, on average, than you get back in claims.
So why buy it?
Because you're making that trade-off again. You accept a small, certain negative financial return, the extra cost of the premium, in exchange for eliminating a potentially large, uncertain loss. You're buying peace of mind.
And insurance isn't just companies, right? You mentioned families.
Absolutely. Social safety nets, unemployment insurance provided by the government, even just families supporting each other. These are all forms of insurance systems designed to cushion blows.
Okay. Strategy 4.
Hedging. This involves acquiring an offsetting risk.
Offsetting risk. How does that work?
You basically take on a second risk that tends to move in the opposite direction of the first risk you're worried about. The goal isn't necessarily profit, but stability.
Give me an example.
Southwest Airlines famously did this with fuel prices. They worried about rising fuel costs hurting profits. So they bought financial contracts, hedges, that would pay off if fuel prices went up.
So if fuel got expensive, their operating costs went up.
But their hedge came out offsetting that increase. It stabilized their profits even when oil prices were going wild, while competitors without hedges saw their earnings swing dramatically.
So it cancels out the volatility. Like if I'm a huge fan and my team is in the final, I could bet against them.
Haha, yes. That's a classic personal hedge. If your team wins, you're happy. If your team loses, you're sad, but hey, at least you win the bet. You've reduced the volatility of your emotional state.
Okay, hedging makes sense. What's the last one?
Number 5, gathering information.
Just finding stuff out.
Pretty much. A lot of what feels like risk is just uncertainty stemming from a lack of knowledge. The more information you have, the better you can assess probabilities and payoffs, and the less uncertain the situation feels.
Like researching a company before investing, or checking the weather before a ski trip.
Exactly. Information is valuable because it reduces risk and allows for better decisions.
But gathering information can be expensive or time-consuming.
It certainly can be. That's a trade-off itself, and it's why sometimes governments or other large organizations step in to gather and provide information that benefits everyone. Think weather forecasts, public health warnings, travel advisories. The cost is too high for one person, but the collective benefit is huge.
Okay, so we have this rational framework, expected utility, and we have these practical strategies, spreading, diversification, insurance, hedging, getting info. It sounds like we should be pretty good at handling risk.
You'd think so, wouldn't you?
But I suspect we're not.
We are often demonstrably not. And this is where behavioral economics comes in. It studies how psychological factors systematically cause us to deviate from those rational models. We take mental shortcuts, we have biases.
We mess up.
We mess up, often in predictable ways.
What's the biggest culprit? Where do we go wrong most often?
A huge one is overconfidence.
Thinking we're better than we are?
Exactly. Overconfidence is the tendency to overestimate the accuracy of your own knowledge and forecasts. Think about surveys asking people if they're better than average drivers.
Oh, yeah. Isn't it like 80% of people say they are? Which is mathematically impossible.
Right. And I bet if we asked you.
Yeah, I probably think I'm in the top half, at least. Maybe top 20%.
See? That's the bias in action. And it's dangerous. In finance or business, it leads people to underestimate risks.
Like an entrepreneur thinking their great idea can't fail, ignoring the statistics on startup failure rates.
Precisely.
Yeah.
Or trading stocks too often because you think you can predict the market. Overconfidence makes you ignore risks and potentially ignore good advice or strategies like diversification.
Okay, overconfidence. What else trips us up?
The availability bias, or availability heuristic.
Availability, meaning what it's easy to remember.
Exactly. We overestimate the likelihood of things that are vivid, recent, or easily recalled, often because they get a lot of media attention.
Like worrying more about, say, a shark attack or a plane crash.
When statistically, you're far, far more likely to be harmed by something mundane, like falling furniture or a car accident on your way to work.
Because the shark attack is dramatic and makes headlines, while falling dressers don't.
You got it. The vividness makes it feel more probable than it actually is. The solution: force yourself to slow down. Look up actual statistics. Don't rely on what just pops into your head.
Good advice. Okay, what's another bias?
Anchoring bias.
Yeah.
This one is subtle but powerful.
Anchoring, like a boat anchor.
Kind of. We tend to latch on to the first piece of information we receive, the anchor, and then we don't adjust our thinking away from that anchor enough, even when we get new information.
How did that play out?
Classic example is in negotiations or valuations. If a seller asks for a really high price for a house initially, even if it's unreasonable,
Potential buyers, and even appraisers sometimes, tend to estimate the house's actual value as higher than if the initial asking price had been low.
exactly, that first number anchors their perception. Another everyday example.
Yeah.
Look at your credit card bill, that minimum payment amount.
Oh,
That's often an anchor. People see that small number and might pay only that, or just a bit more, even if they could afford to pay off a larger chunk. The anchor subtly influences them to pay less.
wow, I never thought of it that way. Okay, that's sneaky. Next, bias.
Representativeness bias.
Hmm.
This is judging the likelihood of something based on how well it seems to match a particular prototype or stereotype you have in your head.
So judging a book by its cover,
Right.
essentially.
Pretty much. Instead of looking at objective data or base rates, you ask, does this situation or person look like my mental image of X?
How could this lead to bad decisions?
Well, think about hiring. A manager might unconsciously favor a candidate who looks like their stereotype of a successful leader, maybe based on past colleagues or even media portrayals, rather than rigorously evaluating the candidate's actual skills and experience against the job requirements. It can lead to poor hires and, frankly, discrimination.
Yikes. Okay, one more. You mentioned earlier that losses hurt more than gains feel good because of utility. Does that show up as a bias too?
It absolutely does. It's called loss aversion. And it's powerful. Studies suggest that psychologically, a loss feels about twice as impactful as an equivalent gain.
Twice as much. Wow.
Yeah, and this intense aversion to experiencing a loss can really distort our decisions, making us irrational.
How so?
The classic example involves sunk costs. Let's say you bought a stock for $100. It's now trading at $70, and based on new information, you don't think it's going to recover. Rationally, the $100 you paid is gone. It's a sunk cost. The only decision now is whether holding the stock from $70 onwards is the best use of your capital.
Right. What you paid originally shouldn't matter.
But loss aversion screams at you. Selling at $70 means realizing the $30 loss, making it feel concrete and painful. So people irrationally hold on to losing investments, hoping they'll get back to break even when that's not the likely outcome.
Just to avoid the psychological pain of admitting the loss.
Exactly. You end up making a bad financial decision purely to avoid a bad feeling. Same thing happens with selling houses, holding onto memberships you don't use. Loss aversion is everywhere. Hashtag tag outro, summary, and final thought.
So that was quite the journey through uncertainty. We started with the core idea that most of us are risk-averse and that this stems naturally from diminishing marginal utility.
Right, the fact that losses hurt more than gains feel good, in well-being terms.
Then we laid out the rational framework for dealing with this, calculating expected utility to make systematic choices.
Weighing the utility of outcomes by their probabilities. And because we are risk-averse, we looked at 5 key strategies people and markets use to reduce risk. Spreading it out, diversifying, insuring against it, hedging, and gathering more information.
Practical tools to manage the unavoidable.
But finally, we acknowledge that even with the rules and tools, our own psychology often gets in the way. We covered those key behavioral biases.
Overconfidence, thinking we know more than we do. Availability, overreacting to vivid stuff. Anchoring, getting stuck on initial numbers. Representativeness, relying on stereotypes. And that powerful loss aversion, hating losses more than we like gains.
That's a great summary. Understanding this whole picture, the rational model and the psychological pitfalls, is crucial.
Yeah, it feels like having this framework means you're less likely to just react based on fear or gut feeling and more likely to make, well, genuinely better decisions when things are uncertain. Gives you a way to think it through.
Absolutely. And perhaps that leads us to a final thought for you, the listener, to reflect on. We've discussed how, rationally, for very small stakes, the diminishing marginal utility effect is tiny. You should be almost risk neutral for, say, that $1 coin flip we started with. We also know your brain is wired for loss aversion and susceptible to biases like anchoring.
Right.
So the question to ask yourself is this. Knowing that your instincts are probably flawed for small risks, where in your everyday life with your money, your time, even just your stress levels, are you currently paying a premium to avoid some small, essentially neutral risk, simply because you're letting those gut feelings, that aversion to any potential loss, override a more rational judgment? Where are you letting instinct rule when logic should prevail?